Today, I will explain question number 10. In this problem, we need to prepare cash flow statement. Here, balance sheet and profit and loss account income statement is given. First, let us look at balance sheet. Share capital is given. There is no changes. It comes under financial activity. Secured loan is given. Comes under financial activity. Creditors, current liability. Tax payable or provision for tax. So here provision for tax, opening balance, closing balance is given. 2004 information, 2005 information, and in statement of profit or loss, tax, current year tax is given. So we need to prepare provision for tax or tax payable ledger account. Profit and loss account is given. Current year 10,000, previous year accumulated profit is 7,000. So current year profit minus previous year profit gives you current year profit. Asset side, plant and machinery is given. Inventory is given. So plant and machinery comes under investing activity. So this is current asset, inventory current asset, debtor current asset, opening balance of cash, closing balance of cash is given, prepaid expenses current asset. This is regarding balance sheet. And in profit and loss account, gross profit is given, general expenses, depreciation, current year depreciation, non-cash expenses, taxes, income tax. So current year provision is 4,000. Dividend paid is given. This is appropriation of profit. Dividend paid is given. Okay. So adjustment, nothing is given. So here, when it comes to ledger account, we need to prepare tax payable account, and plant and machinery depreciation is given. So plant and machinery account should be prepared. Okay, first share capital, there is no change. Secured loan comes under financing activity. First year secured loan is 0, second year 40,000. Secured loan increase, it means the company has borrowed 40,000 worth of secured loan. Financing activity, it shows inflow. Secured loan inflow of 40,000 rupees. Creditors, current liability increased. So if current liability increased, it should be added in operating activity. So increase in current liability, creditor. So here creditor increased by 39,000 minus 14,000. So increased by 25,000. Tax payable. So provision for tax account is prepared. Tax payable account. So tax payable is liability. Liability will have credit balance, opening balance on credit side. By balance brought down. So opening balance is 1,000 and closing balance is 3,000. To balance carried down. 3,000. Next, profit and loss account. Current year accumulated profit is 10,000. Previous year accumulated profit is 7,000. So difference is 3,000. 10,000 minus 7,000. The difference is 3,000. 3,000 is net profit. So net profit 10,000 minus 7,000. Net profit is 3,000. Liability side is over. Next, go to asset side. First, plant and machinery. We have prepared plant and machinery account. Take opening and closing balance of plant and machinery. Opening balance is 50,000, closing balance is 91,000. Asset will have debit side, brought down opening balance on debit side. To balance, brought down, so opening balance 50,000, closing balance by balance carried down, closing balance is 91,000. Inventory current asset increased. If current asset increased, should be deducted. So current asset increased to the extent of 40,000 minus 15,000, 25,000. In second year, inventory is increased here. Increase in current asset, inventory 25,000. Next, debtor is also increased to the extent of 15,000. Current asset increased, debtor increased to the extent of 15,000. Next, cash, opening balance 20,000, closing balance 7,000. Opening balance of cash should be added to net increase or decrease in cash. Opening balance 20,000, add 20,000 here, and closing balance is 7,000. So final answer is 7,000. Next, prepaid expenses 2,000 first year, 4,000 is second year. So prepaid expenses increased to the extent of 2,000. If current asset increased, it should be deducted in operating activity. So increase in current asset, prepaid expenses. Prepaid expenses increased to the extent of 2,000. Okay, balance sheet is cleared. Next, go to statement of profit or loss or profit and loss account. In profit and loss account, depreciation is given. Current year depreciation 8,000. So depreciation non-cash expenses. In operating activity, add a depreciation. Depreciation 8,000. And number 2, we have prepared plant and machinery account. So depreciation should be credited in plant and machinery. Journal entry depreciation debit, plant and machinery credit. Plant and machinery credit side by depreciation. Amount 8,000. Okay, depreciation non-cash expenses, it is added in operating activity. Taxes, income tax, provision for tax. So current year provision is 4,000. So provision, so we have prepared provision for tax account. Current year provision is 4,000. So provision should be written on credit side by provision for tax. Amount, current year provision is 4,000. Number 2, so provision should be added to net profit. Add provision for tax. So provision is 4,000 and still we don't know how much tax is paid. So we will get to know the amount of tax paid after closing this tax payable or provision for tax account. So this 4,000 is provision for tax. So after closing this, we will get here the tax paid amount. That tax paid amount should be deducted at last. So here tax paid should be deducted. So provision for tax should be added. Don't get confused. These both are not same. So here we add 4,000 and we should not deduct same 4,000 here, because that same 4,000 may not be the tax paid amount. So here how much tax paid should be deducted? Provision should be added. So as per problem, current year provision is 4,000. Provision for tax. Add provision for tax. Provision for tax is 4,000. I'll write it in inner column. Okay, tax is over. Next we have dividend. Dividend should be added to net profit to calculate profit before tax. As dividend is appropriation of profit, dividend should be added here. Dividend. So, amount 1,000. And this 1,000 dividend paid should be written in financing activity. Dividend is related to financing activity, so dividend paid should be deducted. Dividend paid. Amount 1,000. Dividend paid should be deducted. Okay. So all the informations are filled. Next, close ledger account. First, close provision for tax ledger. Credit side is more. 4 plus 1, 5,000. 5,000 on debit side. 5,000 minus 3,000, 2,000. So this 2,000 is tax paid during the year to bank. Tax paid. So this 2,000 tax paid should be deducted in operating activity. Tax paid will be 2,000. 2,000 tax paid. And close plant and machinery account. We have credit side more. 91 plus 8, 99,000. So 99,000 minus 50,000, that is 49,000. So 49,000 is plant account debit to bank. It means purchase of plant to bank. The balancing figure 49,000. So it is, we can treat this one is as purchase of plant. So purchase of plant is investing activity. Investing activity, purchase of plant. $49,000. I'll write amount in outer column as there is only one transaction. So 49,000 indicates cash outflow. So it should be written in negative terms. Okay, both the ledgers are closed. Now finally close cash flow statement. So profit before tax 3,000. 4 plus 1, 5,000. So profit before tax is 8,000. Non-cash non-operating expenses, total non-cash non-operating expenses 8,000. So 8,000 plus 8,000, 16,000. Non-operating income, nothing. Operating cash before working capital changes is 16,000. So add decrease in current asset and increase in current liability. So 25,000 should be added. 25,000. 25,000 plus 16,000. 25,000 plus 16,000. 41,000. So 41,000 minus this balance. 25,000 plus 15,000 plus 2,000. So 41,000 minus 42,000. So it is negative 1,000. Cash flow from operation is minus 1,000. There is no cash inflow from operation. So excess 1,000 cash outflow from operation. So this one minus 2000, it's minus 3000. Minus 3000 is net cash from operating activity. Next, this is A, and point B, net cash from investing activity is 49,000, minus 49,000. Okay, so this is part B. And part C, $40,000 minus 1,000, it is 39,000, positive 39,000. So A plus B plus C. So A is 3,000, I mean minus 3,000, minus 3,000. B part is minus 49,000. And C part is plus 39,000, plus 39,000. So A plus B plus C is minus 13,000. Net increase or decrease in cash. Net decrease in cash is minus 13,000. So minus 13,000 plus 20,000 is 7,000. This is closing balance of cash.